Hello, and welcome back to our YouTube channel. Today, we're going to look at a couple of the key things you need to think about before you start investing. In our last few videos, we looked at how important it is to understand the incredible power of compound interest, how you might find at least some money for investment, and why this is so worth doing, even with relatively small amounts of money. As we've seen, successful investing throughout your adult life really can turn hundreds of pounds into more than £1 million over time. This is what stock market investment can deliver over many years. The tragedy is that far too few people understand this stuff and take advantage of it, which is something we want to change. If the idea of hundreds of pounds building to more than £1 million seems like nonsense and wildly unrealistic to you, please do consider watching some of our previous videos. Or you might also think about spending a bit of time plugging numbers into the compound interest calculator on the website calculatorsite.com to get a real sense of what is possible here. We'll provide a link to the site below. So as we've seen in a previous video, 60% of British adults don't understand this stuff, which is why they don't invest. And spending a bit of time seeing how the numbers work is time very well spent in my view. So today, we're going to look at two really important things you need to do before you're ready to invest. First, to pay off any expensive debt you might have. And secondly, to build up a rainy day pot of cash, a cash buffer. These are both key steps on the road to getting your finances sorted. So let's look at each of them in turn. The first thing to say then is that you really must make sure you pay off any credit card or other expensive debt before you do any investment. This is very simply because the interest rate your credit card or loan provider will be charging you on any outstanding balances you may have will almost certainly exceed the return that you can make on your investments, unless you're very lucky, very clever, or both of those things. This might seem obvious to many of you watching, but you'd be surprised how often people get in touch with me, excited about starting off with investment, but who still have significant credit card or other unsecured and expensive debts. I see this a lot in the crypto space in particular, where it's not uncommon to see people even taking on credit card debt to make investments in crypto. So today, I wanted to be very clear that this is a really bad thing to do. Putting money into any kind of investment whilst you still have any kind of costly debt outstanding is a bit like filling a bath with the plug hole open, where the speed that the water disappears down the plug hole exceeds the speed at which the tap is filling the bath. Please note, however, this may not apply to cheap debt. If the interest rate on your debt is lower than the return you can make on your investments, then there is a chance that the proverbial bath might fill faster than it empties, if you get my drift. But this is something you need to be very careful about. The most obvious potential example of this is mortgage debt. For many people, it might be perfectly sensible to allocate something to a pension or a stocks and shares ISA account or both each month, whilst you still have mortgage debt, for example. It is important to think reasonably deeply about this, however, particularly with interest rates being much higher today than they were in the recent past. When interest rates were, say, 2%, it was something of a no-brainer to prioritise stock market investment over paying down your mortgage, given your returns, over a long enough period of time at least, were likely to be higher than that 2%. With interest rates so much higher today, however, this is no longer as clear-cut. The key thing is to get the mix right over time. My own belief is that it is probably worth allocating at least some money to long-run stock market investment over and above paying down your mortgage, given your returns over time will hopefully exceed the interest rate you're paying. But there is no clear answer here, given that the right approach, such as there is one, will be based on your own very personal circumstances. We're going to look at many of these sorts of considerations in future videos in the weeks and months ahead, by the way. In the meantime, however, what is very clear is that you really must pay down any expensive debt, such as credit card debt or high-interest bank loans, before making any kind of investment. If you don't do this, there is a high chance you won't make any forward progress financially, and investing will be a waste of time at best, and really potentially very damaging for you financially in a worst-case scenario. So, as boring as this might sound, particularly if you're excited about getting started with investment, as many people are, you should allocate any spare cash that you've managed to find each month, perhaps having watched our last video, to paying down any expensive debt first. The next important thing to consider is that you should also not begin to invest until you've built up a decent buffer of cash savings. In my second book, Live on Less, Invest the Rest, I describe this as a rainy day pot. Most experts in personal finance suggest that when you start saving, you should keep 100% of those savings in cash until you've built up a cash buffer which could cover you and any family you might have for a certain amount of time if you were to lose your job, for example, or just to cover any unforeseen expenses that might arise in your life. Different commentators advocate different sums of money here, but the convention seems to be anywhere from 1 to 6 months of your salary. What you decide to do in this respect is entirely up to you. I would suggest that if you feel safe in your job, or if you're reasonably skilled and could find a new job fairly quickly, you might consider 2 or 3 months sufficient, but by all means do consider keeping more than this buying cash, particularly if you have children. So to be clear, I'm suggesting that you do not begin to invest any money into financial assets, such as the stock market, investment funds, and certainly any crypto, until you have first saved a decent lump of cash that you can then keep in cash forever. Only once you have done this can you then start allocating some of your monthly savings to investment with real peace of mind. So to conclude overall, do not begin to invest any money into things like stock market funds and certainly not crypto until you first paid off any expensive debt you have and saved up a decent rainy day pot in cash. Although this might seem incredibly boring, it is the lowest risk way to go and will reduce the likelihood that you make the very painful mistake of losing money on investments whilst you're still paying high interest rates on outstanding debt, which can be a particularly gruesome scenario and one that's been experienced by all too many people over the years. By the way, as an aside, if you'd like to learn more about this stuff, you might consider reading a classic book which has lots to say on the subject of getting rid of debt, which is George Clason's 1920s classic, The Richest Man in Babylon. As the Los Angeles Times have said of this book, what can a book written in the 1920s tell modern investors about their finances? A whole lot if it's George Clason's delightful set of parables that explain the basics of money. This is a great gift for anyone who seems baffled by the world of finance and a wonderful, refreshing read for even the most experienced investor. I think it's definitely worth a look. So that's it for today. As you look to get yourself to a point where you can start investing, make sure you first pay down any expensive debt and build up some cash. So over our last 11 videos, we've got through a good number of key introductory ideas about saving and investing. We've looked at how important and potentially life-changing it is, how to go about finding the money, and how today to ensure you're ready. In our next few videos, we're going to start to turn our attention to some of the specifics. We're going to look at the accounts you need, most particularly your pension and ISA accounts, and at how to think about using them both. And we'll also look at the different investing asset classes, such as shares, bonds, real estate, commodities, etc., at the crucial importance of investment funds, and at some of the key ways of approaching finance which can maximize your potential returns and reduce your potential risks. As ever, if you want to ensure that you're one of the first to see these videos when they're published, please do click the subscribe and bell buttons. We're pretty keen for you to do that, as any other YouTube channel is. So if you're enjoying these videos and getting something from them, please do subscribe. Please also consider sharing our videos on social media if you share our belief in how important financial literacy is for all of us. The last thing I wanted to say before I sign off today, by the way, is that I'm going to be taking a short break with my family for the Easter holiday next week. And this means that our next video may not be published until later in April, rather than a fortnight from now, which is the normal cadence. Until then, I wish you and yours a fantastic Easter break too, and look forward to seeing you then.